Let's talk about something we all deal with, but let's be honest, very few of us really get: taxes. But what if I told you that you might be paying thousands more than you actually need to, year after year? Well, in this explainer, we're going to dig into some powerful and totally legal ways to keep more of your own money in your pocket. Let's jump right in. I want you to really let this sink in. Taxes are going to be one of the largest expenses of your life. Now, that's not me saying that. That's a quote from a qualified accountant. And it's exactly why understanding this stuff isn't just a nice to have. It's absolutely essential for your financial health.
And that's the big question, isn't it? It's the one that could literally change your financial future. So today, we're unpacking 3 powerful strategies from a financial expert that could seriously lower your tax bill. But before we get to the good stuff, we have to bust a huge, huge myth.
Okay, so first things first. Before we can learn the rules of the game, we've got to unlearn some of the bad information out there. And believe me, there's one giant misconception about taxes that trips so many people up.
This right here, this gets to the heart of a major fear people have. If I get a pay rise, will I actually take home less money because of taxes? The myth says yes, you will. But the reality? No way. It's just not how it works. Thanks to something called a progressive tax system, you only pay that higher rate on the new money you earn. A pay rise will always mean more money in your pocket. Here, let me show you exactly what I mean.
Let's use a super simple example to make this crystal clear. Okay, imagine these are the tax brackets. You pay 0% on your first 10 grand, then 20% on the next chunk of your income, all the way up to 50,000, and then 40% on anything you earn above that. So, if your salary is 60,000 pounds, you don't just pay 40% on the whole thing. No. Think of it like filling up buckets. The first bucket, that's your first 10,000 pounds, is taxed as 0. Zilch. Then the next 40,000 pounds goes into the 20% bucket. And it's only that last little bit, that final 10,000 pounds, that spills over into the top bucket that gets taxed at 40%.
So, what's the grand total? The final tax bill comes out to 12,000 pounds. That means your actual tax rate on your total salary is only 20%, not that scary 40% you might have been worried about. See? Not so bad. Now that we've got that cleared up, let's talk strategy.
All right, with that myth totally busted, let's dive into our first real actionable strategy. And this is a big one: using your pension contributions to legally shrink the amount of income you're taxed on in the first place.
So, what exactly is a pension contribution? The easiest way to think about it is this. You're paying your future self before you pay the government. It's money that gets taken out of your salary and put straight into a retirement account before income tax is even calculated.
And the way it works is actually pretty brilliant. You earn your salary, right? But before the tax man even gets a look at it, a chunk that you decide on is whisked away into your pension. So what's the result? You're only taxed on the smaller amount that's left over. It really is one of the simplest ways to lower your tax bill. And just look at the difference it can make. Using our same 60,000 pound salary, if you don't contribute to a pension, your tax bill is 12,000 pounds. But if you put 6,000 pounds a year into your pension, look what happens. Your taxable income drops to 54,000 pounds, and your tax bill, it drops all the way down to 9,600 pounds. That's a 2,400 pounds saving on your tax bill every single year. And you did it just by paying your future self first. It's a genuine win-win. You're building up a nice retirement pot, and you're getting an immediate tax break for doing it. Now, there are a couple of really important things to keep in mind here. The biggest pro? Employer matching. If your company offers this, it means they'll put money into your pension just because you are. That's literally free money. You have to take it. The main con, or the catch, is that this money is usually locked up until you hit retirement age, so it's definitely a long-term strategy. Okay, let's move on to strategy number 2. Now, this one is a real game changer if you have any kind of side hustle, if you're a freelancer, or if you run your own business. It's all about flipping how you think about money coming in and money going out.
This right here is a massive shift in thinking. As an employee, the order is always earn, then get taxed, then spend what's left. The tax man always gets his cut first. But when you operate as a business, the order is earn, then spend, and then get taxed on what's left over. You get to spend on business needs before the tax is calculated. That is a huge advantage.
So what kind of stuff can you actually count as an expense? Well, you might be surprised. If you're a YouTuber, for example, your camera, your microphone, that new laptop for editing, all expenses. It could even be a slice of your electricity bill for your home office, a course you took to improve your skills, or even a coffee you bought during a business meeting.
But wait, it gets even better. Here's the real kicker. The tax a business pays on its profits, that's called corporation tax, is very often much lower than the personal income tax rates we've been talking about. So by keeping money inside the company to reinvest and grow, you're paying tax at a much, much lower rate.
All right, our final strategy today is a bit different. It's not really about cutting your tax bill right now, this year. No, this one is all about the long game. It's about making sure all the money your money makes in the future is 100% tax-free.
We're talking about these special investment accounts, like an ISA in the UK or a Roth IRA in the US. Think of them as having a superpower. They were designed by the government to encourage you to invest, and their special power is to create a shield around your investments so that the tax man can never touch your profits.
Now, this is a super important difference to get. With a pension, you get that tax break upfront, right away. With these accounts, it's the other way around. You use money that you've already paid tax on to invest. So why bother? Because all the growth, all the dividends, all the profit your money earns for years and decades, it's all completely tax-free when you decide to take it out.
Just imagine this. Your investments double or triple over 20 or 30 years. In a normal investment account, the taxman would be waiting to take a big slice of those profits. But inside one of these tax-free accounts, every single cent of that growth is yours, all of it. Over a lifetime, that difference isn't just a few £1,000s, it can be absolutely life-changing. So let's wrap this all up. We've debunked the biggest myth that holds people back, and we've walked through 3 incredibly powerful strategies you can use to legally pay less tax, both today and well into your future. So what's the most important next step?
And this brings us to what might be the most crucial point of all. Please think of this as your education, not as specific financial advice for you. As the expert we're citing makes really clear, spending a bit of money for a consultation with a real professional is an investment, not an expense. It's well worth it because they can take these ideas and apply them directly to your life and almost certainly save you way, way more than their fee. So, there you have it. The knowledge is now in your hands. A pension for instant tax savings, a business structure to make your side hustle more efficient, or a tax-free account to build wealth for the future. You've got 3 powerful tools in your toolkit. The only question is, which one are you going to look into first?